Now, next to me, we have a very famous content producer. Okay, he is a leading personal. He is one of the co-writer for kclao.com, and which is a leading personal finance blog in Malaysia. And he is also the columnist of the Fifth Person Value Invest Asia or majalah labro.com. If you happen to read any of the company case study on Fifth Person Value Invest Asia about Malaysian companies, chances are you'll be reading about his article. Okay, trust me, I read a number of his articles and he's really nicely written about the fundamental of the companies. Thanks. And then he is also a dividend investor. He personally collects 8 to 9 months in dividends from his own portfolio every year, averaging about 6% a year in the dividend yields. Currently, his stock portfolio got Malaysia and Singapore. Okay, and he is none other than Ian Tai. Okay, and welcome to our BURSA webinar tonight.
Yes, thank you once again, Chun Sian. Thank you so much for your such a wonderful and very enthusiastic kind of introduction. Makes me feel very welcome.
All right, cool. Now, could you tell us what actually is a real estate investment trust?
Okay, very simple. Real estate investment trust, first and foremost, is made out of 4 words. The first 2 is actually real estate, which means we are dealing with properties, all right? And more specifically, we are going to deal with commercial properties, all right? The ones that I personally, I'm not too sure about Chun Sian himself, but I myself, I cannot afford one. So
you can
I cannot buy the entirety of the property unit. So that's the first 2 words, real estate. Of course, investment, it is actually not, there are a few things. You can actually buy a property development company like Marsing, Sunway, or let's say ROI properties and stuff like that. But this is investment. Investment meaning to say you are actually dealing with rental income. All right. So it is something like a process where it is actually like you buying a physical property and rent it out to your tenants, and from which you get rental income. But for real estate investment trust, the property is actually held within the trust, and we come in as an investor. All right, we buy the trust, some units of the trust, and indirectly we own a few units of a small little minute percentage of the property, and from it we get a share of the rental income. So basically that is real estate investment trust. So do I begin?
Yeah, sure.
Yeah, sure. Okay, I've actually prepared a lot and have a lot of materials in store for you guys.
Wow, that's great.
Yes. So I would like to actually cover the basics as quickly as possible because I have actually prepared my own personal investment, which is to be shared as a case study for today. And of course, I would love to answer your questions after this particular webinar. So let's begin. So this is actually real estate investment trust. As you can see, I purposely choose IGB REIT. This is actually a screenshot from this annual report. The reason why I choose this REIT to begin with is because this REIT has only got 2 properties. Guess which 2 properties?
I know. It is Mid Valley and the Garden.
Mid Valley and the Gardens, correct. So Mid Valley is the biggest shopping mall in Malaysia, and the Gardens is the shopping mall which is more atas, more high class than if I may say that, just located right beside it. Okay, so we have a few parties that is involved in IGB REIT. So first and foremost, okay, at the center we have IGB REIT, and if you look below, all right, it says ownership of properties, and it states their property portfolio. So which means IGB REIT will be the owner of the following properties, which is Mid Valley Mega Mall and as well as the Gardens Mall, as stated by Chun Sian. Okay, so that's the first party. Then beside the property portfolio, can you see there's 2 words known as a property manager? So which means to say there are properties and we have a manager to manage the properties. Maybe they will take care of the maintenance, the upkeeping of the properties. So we have a property manager. Okay, that's the second party. And then if you look a little bit above, we have 2 different parties where it has, on the left we have other unit holders, and on the right we have sponsor or major unit holder. So major unit holder means to say it is actually the biggest, the largest unit holder of the REIT, which is IGB REIT, and the sponsor is IGB Berhad. Now, there's a term called sponsor because sponsor is actually very important. If you have here's a key golden nugget for those of you who are investing in a REIT. Find a REIT where the sponsor, all right, means the major, usually the sponsor is always the major unit holder. Find a good sponsor, all right, especially the ones that develops properties, very important. Okay, because if let's say a sponsor has a lot of assets, especially the good ones, on and off they may give the rights of first refusal to the REIT itself, so that if let's say these sponsors, let's say IGB Berhad, let's say they have a very good asset and they want to sell it, all right, the rights of first refusal, all right, will allow IGB REIT to actually have the first option to buy over this asset at a very good price, and it will be injected into the IGB REIT. All right, so that IGB REIT will now buy good assets from its own sponsor, and from it they will get more dividend income, more rental income. I mean, and of course, from having more rental income, obviously you are going to get more dividend income. So that's a very good thing to actually look at. Find the ones that have good sponsors.
Okay, will that be a related party transaction? Like, should we be worried because the owner of IGB is selling his own asset to IGB REIT?
There's pros and cons to it. Of course, there's two sides of a coin to everything. So that's why I emphasize on good assets, all right? Because there may be cases where REITs, all right? But I haven't seen in Malaysia yet, REITs whereby the sponsor actually dumping bad assets into the REIT, which causes the REIT to actually perform badly. All right, but this kind of thing, over time it will tell. Over time you will see that, hey, this REIT has a tendency to actually throw in bad assets into a certain REIT and causing the REITs to do badly. But the good ones will tend to have a system whereby we have a sponsor who is into developing properties, and once they have developed the properties, they will rent it out first, and once the rental income is stable, then only they will dispose the asset to the REIT, so that the REIT is a vehicle whereby it's more like a vehicle to hold on to assets. And therefore other unit holders, which is us, can actually buy the assets. All right, so we today, like people like me, people like you, we are under other unit holders. Okay, but who is to actually govern this IGB REIT? So that's why we have a trustee. So in the case of IGB REIT, there is a trustee which is known as M Trustee Berhad. All right, so this is the third party, and last but not least, there's one property manager to manage the properties, the upkeeping and the maintenance of the property. But we also have a REIT manager where it will manage the REIT. All right, that means to say they are the REIT managers, and from here we can see that IGB REIT Management Sdn Berhad is the REIT manager. Okay, so these are the key parties, but the more important ones is this: when you buy into a REIT, you are under other unit holders. All right, when you buy into a REIT, you are buying into a property portfolio that consists of real properties, commercial properties, from which these commercial properties will derive rental income, and after they deduct the expenses, it will distribute the net property income back to the IGB REIT, from which IGB REIT will take the net property income and pay the management fees and the trustee fees to the trustees and to the managers of the REIT, and whatever is net will be given back to you as a unit holder or investor. Okay.
Okay, so sponsor actually means is the major unit holders. Okay?
Most likely, yes.
All right, I see. So the question I want to ask is, what's the difference between a manager and a property manager?
Okay, so IGB REIT, let's say for example we have a REIT manager. All right, so I vision it this way: property manager, they manage the property.
That means collect the rental income,
yes.
Make sure that the facilities are clean, With any issues with the tenants, so that they deal with them.
Yes, and then for REIT managers, they are responsible to manage the REIT. That means to say, like the REIT is actually an entity, all right? It's an entity that collects, let's say after the property manager has collect the rental income, all right? They will have to distribute the income to the REIT manager. And from there, the REIT manager will take the income. And once they deduct the trustees fees, the audit fees, the management fees, and pay all the income tax or relevant taxes, whichever, whatever they may be, then we take the net amount and give it to the unit holders. So there are two parties involved in this particular game.
Okay.
So let's move on, yeah. And in Malaysia, BURSA Malaysia, we have 5 different types of REITs. I'm gonna go through this very quickly. And we have the following 5 types of REIT. So the first one is retail REITs, where most of it owns shopping malls. All right. So like for example, IGB REIT, just now the 2 properties mentioned by Chun Sian they are shopping malls. So therefore it's known as retail REIT. So in Malaysia, we have a few retail REITs, IGB. CMMT stands for Capital Malaysia Mall Trust. Third one is actually Pavilion REIT. The 4th one is Hectare REIT, and the 5th one is KIP REIT. And the second type of REIT is they own office towers, like office buildings. So some of it, majority, I think these are the following REITs, like UOA REIT, MQ REIT. MQ stands for MRCB Q REIT. All right. UOA REIT, KLCC Staple Securities. This is the only staple securities listed on BURSA Malaysia. MREIT and Amanah Raya REIT. We have another classification of REITs, which is industrial REITs, where they invest in factories, warehouses, and logistics properties mainly. All right. So the only one I can find is actually Axis REIT. Sorry, yeah. The 4th one we have is actually Hospitality REIT, where it invests in hotels and resorts. So this one, we actually have only one REIT, which is YTL Hospitality REIT, where it owns hotels and resorts in Malaysia, Japan, and Australia. So this is actually very interesting because it's one of the only REITs in Malaysia where most of its income are derived from Australia, not exactly from Malaysia. The rest of the REITs that I have listed down here, they are mostly Malaysian properties earning Malaysian rental income. But for YTL Hospitality REIT, about 50 to 60% of its income comes from Australia and Japan.
Yeah, like Niseko.
Yes,
the Hokkaido region.
Yes, exactly. But that one is a smaller one. YTL Hospitality REIT, they own, let's say, 3 hotels. One in Sydney, one in Brisbane, and the other one is in Melbourne. They are all Marriott hotels.
Yeah, Marriott level.
So these are the income contributors to the specific REIT. And finally, we have the medical REIT or the hospital REIT, where it will invest in hospitals, nursing homes, and healthcare facilities. And the one and only REIT that is a representative of a hospital REIT is Al-Aqsa Healthcare REIT, where it invests in KPJ hospitals.
They rent.
They rent.
So KPJ is their tenant.
KPJ is their tenant and as well as their sponsor.
Oh, as well as the sponsor. Oh, yes. I see.
So every time KPJ Healthcare Berhad, after they have developed their hospitals, they will inject it into this REIT.
I see. And they sell the REITs.
They sell the REITs, they sell the hospitals to the REIT, and then they will lease it back to KPJ Healthcare Berhad. So that KPJ Healthcare Berhad is not so, it's asset light and they are free out of their capital let's put it that way.
And if they structure it in such a way that they can also save on taxes.
Yeah, you can say that. Correct.
Yeah, that's the primary reason that the tycoon lists the property under category of REITs.
Correct.
Yeah, because to save on taxes.
Exactly. It is a very good way to actually hold on to properties.
I guess later you will talk about the taxes, right?
Yeah, we can talk a little bit about taxes. We can talk about anything related to REITs today. Yeah. So let's move on. Okay, part 3. 5 key traits of successful REITs. Okay, this one is very important. I will go a little bit slower here because this is very dear to me. All right. So these are the following 5 things that I look at when I invest in REITs. The first one I look at is the property portfolio. So before I look at stock prices, I look at dividend yields and all this kind of stuff. I look at the property portfolio. All right. So I will make sure that the properties are of quality. That means to say the location is good. The tenants that occupy the properties are good. All right. So, and of course, when we talk about that, we have to look at the property's occupancy rate. So what is occupancy rate? All right. Let's say, for example, we have a shopping mall and we have and the shopping mall has 1,000 retail spaces. Okay. So obviously you don't want to go into a shopping mall where half of the retail spaces, let's say 50% of it is unoccupied. All right, because if you go into that kind of shopping mall and it's 50% unoccupied, that means to say it's a bad sign lah. That means the shopping mall has some trouble in filling up their retail spaces. So that's a very bad idea. But in most cases for any REITs, I will go with the ones that have above 90% in occupancy rates. All right, so that is the definition of it. And if they can keep way beyond 90% in occupancy rates, means to say whatever spaces they have, they rent it out to people and they are deriving income from their spaces, then that's a very good thing. Otherwise, the occupancy rate, if let's say the property has just been renovated, understandably, it takes time to actually fill up the tenants. If that's the case, then the occupancy rate must grow. So the first one I look at is property portfolio. Make sure that the properties are in good location, in good condition, and they are occupied by quality tenants. Okay. The second one is, of course, I look at the financial results. Here I'll just brief it through. I'll look at the REITs revenue, net property income, distributable income. Okay, that's another word for shareholders' earnings. And finally, we have distribution per unit. Don't worry about all these terms because later I'm going to go through a case study. All right, so I'm just going to brief it through. You just keep it in mind first. Later, I will be going through with you a detailed case study. All right, to actually explain what is being written on the screen. The third one I look at is the balance sheet. Okay, so in terms of balance sheet, we look at its gearing ratio. So gearing ratio for REITs is calculated as follows. Here's the formula. It is calculated by taking the amount of borrowings, total borrowings that it has, and it will divide it by total assets. All right. So in Malaysia, the maximum amount of gearing ratio, the borrowings to total assets ratio is 50%. All right. Meaning to say, let's say we have a house, it costs $1 million, and let's say the mortgage is 300,000. It means to say we take 300,000 in mortgage, we divide by $1 million in total asset. That's the valuation of the asset. So therefore, the gearing ratio is 30%. So for REITs, in this kind of calculation, the maximum they can go is 50%. And of course, what I prefer is that the lower the better for many reasons. First one, low borrowings means lower interest costs. Second means if the REIT has low borrowings, it has the option to borrow more money from the bank in the future in order to buy new assets. More properties, more revenue, more income, more dividends. As simple as that.
So a REIT that is highly geared means that the potential for growth is limited because no more capacity for loan.
Yes, you can say that. Correct. And of course, we have net asset value per unit. So net asset value is calculated like this. All right. So let's say, for example, we have a house which is $1 million, and let's assume that your house, you can divide it into 1 million shares or 1 million units. All right. So each unit is worth $1. Now let's assume that this house over the next year has appreciated to $1.1 million, and we take $1.1 million and we divide it by 1 million units, and therefore your net asset value is now $1.10, which is higher than 1 year before, which is $1. So which means to say, if I see that the net asset value per unit of the REIT has grown, in general, it means that the properties in this in the REIT, right, has appreciated over time. So therefore, their net asset value has grown. All right. So if you see that the net asset value of a property of a REIT has actually declined, then that's not a very good sign lah, usually, because it means that the property has kind of like lost its value or it has depreciated. It happened, all right, in REITs. And finally, I will look at growth plans and strategies. This is very important because a lot of people think that REITs is just a vehicle to get distribution. Not quite, all right? Yes and no. Of course, the primary reason why people invest in REITs, including myself, is to get dividend income. But I don't just want to get the same dividend income, same amount of dividends every single year. I like it better if, let's say, the REIT is going to pay me increasing amount of dividends over time. So therefore, I want to look at whether or not this REIT has any plans, all right, to acquire new properties, to do renovation works that maximizes the usage of the space so that we can get more rental income. Because the more rental income, the more distribution or the dividends that we can actually collect and receive. And this also, once again, relates back to sponsor strength, which means who is the major unit holders, because they have a say, they somehow have some influence on whether or not this REIT can actually grow its property portfolio in the future. All right, so these are the 5 key traits of a successful REIT, if you ask me lah.
Yeah, I see. Thanks for letting us know what are the considerations when we want to invest in a REIT.
Of course, all these things are theory. Now I'm going to look into the application lah. All right, what I said was just, you know, it's just an introduction. This is the real meat of the presentation lah.
Yeah. Just now there were people asking that where does Sunway REIT fall into, because just now you have 5 categories, right?
Yeah.
So, but now we're talking about Sunway.
Sunway REIT, to me, is more like a shopping mall REIT, but I don't really actually put it like in a retail REIT. Okay.
It's a hybrid REIT because it has the property portfolio has a combination of retail, have a combination of office, so it's a hybrid REIT.
It's retail, office, industrial, hospitality, and hospital. Semua ada. And also, it has everything.
Education.
And education.
Do they own Sunway?
Recently, yes.
Recently? I thought Sunway Education is under the foundation, Jeffrey Chia Foundation.
Now it's
under Sunway REIT.
Yes, they bought. Yes, Sunway.
Really?
REIT, yes.
Okay, that is new.
They bought it for $550 million. So it just happened recently. Like I wouldn't say recently but December last year. So it has just been included into the REIT. So Sunway REIT is one that has everything. But to me, it's more like although it has everything, but to me, it's more like a retail REIT for me, because as much properties they have, most of the income still comes from Sunway Pyramid lah. Actually, Sunway Pyramid will constitute like 50 to 60% of the income of Sunway REIT.
Okay, let's do the case study.
So this is my investment details. Okay, so this is when I first bought my Sunway REIT, which is at June 2016 at the price of $1.65. Okay, so at the time, so I'll bring myself back to June 2016 when I was thinking whether or not I should buy the REIT. Okay, so at that time I have the following documents, which is the annual report 2015, the quarterly report 2016 by its quarter 3, and also for REITs, right? For Sunway REIT, the good thing about the REIT is that they come up with investors presentation lah, which is their PPT to tell you their financial performance. And I have the latest, which is quarter 3 2016 lah. All right, so bear in mind that for Sunway REIT, the financial year end for Sunway REIT is every 30th of June every single year. All right, so when I bought it, the time it was somewhere around earlier June 2016. So that means to say I couldn't get the annual report 2016. It's only given to me shortly after I bought the unit. All right, so therefore these are the latest documents available. And back in 2016, here's what happened. Here is what I've gathered. The classification, of course, is a diversified REIT because it has 12 assets in different property classes For example, we have shopping malls, we have offices, we have hotels, and one hospital. The portfolio valuation at the time of the 12 properties is that time it was worth $6.34 billion in June 2016, and the sponsor is obviously property developer Sunway Berhad. Okay, this is what I know. And back in 2016, the portfolio valuation, if I were to make a breakdown, it is as follows. 73% of its properties are shopping malls, and it consists of 4 shopping malls: Sunway Pyramid, Sunway Carnival, that's in Penang, Sunway Putra Mall, which was acquired in March 2011, and Sun City Hypermarket Ipoh, but that one is more like a small little property lah, so it's not so substantial. Then the second class, which is of significance, is the hotel. So we have Sunway Resort Hotel and Spa, which is located right beside Sunway Pyramid. Pyramid Tower East, which is also within the Sunway City cluster. Oh, talking about Sunway City cluster, it has a lot of properties. So when I mention about Sunway City cluster, right, it's like a kingdom lah. If I were to describe it, it's like a kingdom where it has Sunway Pyramid, the hotels, the office towers, and the Sunway Medical Center. So it's like
this is township lah. It's a big township.
It's a township lah, but I like to call it kingdom lah.
Okay.
Of course, you can Google it up, then you'll see why lah. All right. When it comes to the hotel, it owns 14% of it. 14% of its portfolio consists of hotels like as stated as followed: Sunway Resort Hotel and Spa, Pyramid Tower East, Sunway Hotel Seberang Jaya, Sunway Putra Hotel, which is acquired at March 2011. And finally, we have a Penang Hotel, which is Sunway Hotel Georgetown, which was acquired in January 2015. And it has 4 offices: Menara Sunway, which is part of the city cluster, Sunway Tower, which is also part of the Sunway City cluster, Sunway Putra Tower, as you can see, is also acquired during March 2011. So March 2011 is a significant month for Sunway REIT because it acquired 3 properties. In fact, it's 3 in 1 lah. The Sunway Putra Mall, the Sunway Putra Hotel, and Sunway Putra Tower. So this is actually the 3 in 1 kind of acquisition lah that was made in March 2011. And finally, we have Wisma Sunway, which is an office building in Shah Alam. That one was acquired in March 2015, but that one is a small property. And finally, we have the hospital, which is Sunway Medical Center, which is right at the tip of the Sunway City cluster. So back in 2016, we have, this is what I've gathered. Also, we have the IPO, which stands for during the time, which is 2010, when it was first listed. Its initial portfolio consists of 8 properties, and it was valued at $3.46 billion. All right. So when I bought it at June 2016, it has been through 5 financial years already, and from which we see that the portfolio valuation has increased from $3.46 billion all the way up to $6.32 billion. All right. And where does the growth come from? It's at the right hand side of your screen, where you can see that there's capex, which is renovation. Okay, capex is another word for renovation and refurbishment lah, which means to say they will renovate it to create more space to get more rental income of the same property. Acquisitions, as you can see, 2011 we have 522, right? That stands for $522 million spent on acquisitions. And if you can recall, it is which property do you think that Sunway REIT has actually acquired?
Back in
2011, the 522.
Wow. Was it Pyramid?
No, it was Sunway Putra Mall, Sunway Putra Hotel, and Sunway Putra Tower.
Oh, that was 2015, isn't it?
No, that was 2011.
Oh, okay.
Yeah, it will take them 3 years to actually refurbish it, and then 2015, then only they launch it back lah. All right. So that was the 522 all about. And if you see beside it at 2013, we have 313. That's acquisition. So what is that 313 all about? So the money is spent. I didn't actually put the. I should actually put a bracket which is relating to the acquisition of Sunway Medical Center. All right. So it was acquired during December 2012, which is in financial year 2013. Okay, and finally the last one we see here, the acquisition, which is 136. That one stands from the acquisition of Sunway Hotel Georgetown and Wisma Sunway. All right, so the two combined, Sunway REIT has spent 136 million to buy that two properties. So that was what I know at the time. And of course, if you look at fair value gain, it's another word for capital appreciation. So which means like you buy a house at $1 million. If next year your house is worth 1.1 million, that $100,000 gain in paper, the capital gains, these are known as fair value gains. So as you can see, every single year, Sunway Property has achieved capital appreciation for its property. And if you lump the three up, the renovation, the acquisition of new properties, and as well as the capital appreciation of its existing properties, property valuation has increased from 3.46 billion ringgit to 6.32 billion ringgit, right? So that's very good properties. Let's hope that it translates into higher rental income. So this is revenues, which talks about rental income. And of course, we have the smaller incomes like car park income, food and beverage income, because they own hotels, right? And their
seminar packages,
seminar
meeting,
stuff like that lah. All right, etc., etc. And let's see. So this is Sunway's annual report. So the latest one is actually the red color one, the red color bar. That's the latest figure. That's 2015. And the furthest away from the red color bar is 2011. So as you can see, the retail, we have the CAGR growth of 9%. CAGR stands for compounded annual growth rate. All right. And it states there 9%, but I'm not too, okay lah, it's good to know that it grows 9%, but I'm just explaining to you guys how that thing came up. What is that thing all about lah, the CAGR growth? CAGR growth is actually calculated by, it's actually, what it means is that in the retail, let's start with the first one, the retail division, all right? The retail one consists of the four properties that I've just mentioned, the Pyramid, Sunway Carnival, Sunway Putra Mall, and Sun City Hypermarket Ipoh. So that's the retail segment. We can see that the rental income derived from these four properties has increased from $237 million all the way up to $333 million. All right. So if you calculate its compounding growth, it's about 9%. So therefore, I put a remark there, growth. Okay. Now, when it comes to its hotel, I put a decline simply because, as you can see there, 2012, the hotels actually made about $71.6 million. But over time, you see the bar is actually decreasing. It's on the decline. And it dropped to 61.3 million. So I put there a note, decline. Now, when it comes to the offices, it has practically no growth. I don't look at oh, the CAGR growth 3%. No, I look at the overall pattern, and what I find is that it went up one year, it went down the next year, it went up another year, and it went down another year. So to me,
it's flat.
It's flat lah. To me, I just put it flat because I look at the figures, more or less, the offices made about 30 to 40 million per annum. And finally, we have others. So others stands for Sunway Medical Center. And from it made about 20 million a year, starting from 2014. Now, if you see that there's a 2013 figure, which is about 10 million. So let me explain why there's a jump from 10 million to 20 million. Now, Sunway, the financial year end is June. Okay, so that means to say their financial reporting period starts from 1st July to 30th June. So for Sunway Medical, they they actually bought their hospital right at December 2012. So which means the financial year 2013, then the $10 million or 9.6 million that you see on the screen represents a 6 months period from 1st January 2013 all the way to 30th June 2013. That's 6 months period lah. Okay, and of course that explains why. And then starting from 2014, it has a full year financial record, so that's why it's back to 20 million lah, 90 million, then 20 million. Okay, but if you lump it up together, the retail, hotel, office, and others, what I find is that when it comes to the revenues, overall, it has actually grown because the most significant segments of all segments is still the shopping mall segment, which is the retail. So which means the decline in rental income from the hotels, or the decline revenues from the hotels, is not as substantial as the growth in the retail segment. So therefore, the growth in the shopping mall in terms of rental income has driven the overall growth in Sunway REIT's rental income or revenues. So as you can see, sum it up here, it actually grown from 327 million all the way up to 453 million. So overall, good lah, grow, very good. So in terms of net property income, I won't go through the whole growth, decline thing. At the end of the day, you look at the total portfolio, it has actually, the net property income has grown from 244 million all the way up to 341 million dollars. So I think overall is pretty good lah. All right. But with that said, there are two declines over there, the hotel and the offices. So I'll keep that as a note. All right. Now overall, if you see here, back in 2016, I've just mentioned about the gross revenue and the net property income. And finally, we are looking at income available for distribution. This is actually very important because this is income that will be distributed to you if you are the shareholder or the unit holder of Sunway REIT. So growth in gross revenue and growth in net property income will eventually lead to growth in income available for distribution. For Sunway REIT, it has grown from $177 million all the way up to $256.6 million. So which means it is a kind of REIT that pays out more and more dividends or more and more distributions to its unit holders over time. So this is something that I look at of great importance. If this thing they don't have, then you can actually forget about. I personally would ditch the REIT lah. Okay, so for me, this is actually a good example of a REIT that that has actually delivered sustainable growth in distribution to its unit holders. Now, I have actually put there a note. The growth is driven mainly by these three properties, the acquisition of Sunway Medical Center, and as well as the consistent growth of rental income and net property income from Sunway Pyramid and Sunway Carnival. And this growth have overpowered the decline from Sunway Putra Mall, Putra Tower, and Putra Hotel. But I put there a bracket R because I think it's very important to note that the decline from these three properties is not due to bad performance. It's due to renovation. That means they buy and then they start to renovate. So of course, when you renovate, how are you going to make money? Because you can't rent it out, right? Or there's a disruption in getting rental income. Because who wants to, set up a shop in the shopping mall that is still renovating? Or not to say, let me rephrase. Who wants to open a shop in the shopping mall where most part of it is renovating? If it's one part, maybe you still can accept lah. But if it's the entirety of the property, then you have to consider lah. So during that period, the decline was due to some renovation going on in these three particular properties. But I put there Sunway Tower and Sunway Pyramid Tower. There's no R over there because that one really, maybe there's a lackluster in performance for these two properties. Okay. Now, when you have growth in revenue, net property income, and income available for distribution, it's very important to check this figure, distribution per unit. So back in 2016, as you can see, it has actually increased from 6.58 cents all the way up to 8.73 cents. Now do note that for every single annual report, all right, for all the REITs, when they disclose the distribution per unit, it is actually a gross amount, which is not exactly the amount that you will receive as a unit holder, because there is a later I'll show you why. All right,
there's a withholding tax.
There's a withholding tax, and how to calculate that, I have that prepared for you, so just stay tuned for it.
Definitely there'll be a question about that.
Yes.
Yeah, I just want to ask you, just now you said that the growth factor come from the Sunway Medical Center. Is it, how does a REIT make money from the Sunway Medical, like from a hospital? They rent a hospital operator, right?
Yes.
But because you see that there's growth factor, so I don't see that Sunway Medical Center opened so many centers back then, like only one. But how can the income grow so fast?
Good question, because usually a hospital deal, right, is always a long-term deal. All right, so whenever they lease a hospital, let's say for instance, Sunway Medical Center, it's a 10-year deal. Means to say it's starting from December 2012. All right, it will be Sunway REIT will be the owner of the hospital, and it will be leased to Sunway Medical Center Sdn Bhd for a period of 10 years. And there's an initial rent, which is about 19.6 million, and from which we have a rental escalation.
So every year they raise the rental, by a big amount.
Yes, by maybe 2 or 3%. We have to look right at the annual report. I forgot what's the amount, but there's a fixed. But what I know is that there's a fixed income growth, so that it somehow actually guarantees an increase in rental income over the next 10 years lah. And usually for hospital deals, right, it's usually that way lah. It can be a 10-year deal, it can be a 15-year deal, depending on what hospital lah. Okay, now let's move on. Balance sheet strength. Okay, so balance sheet strength, this one I will just pick on a few figures to look at. Number one, we have total borrowings, which is $2.16 billion. That's the amount of borrowings that Sunway REIT has. Okay, now as you can see, we have average cost of debt. That one is 3.88%. Okay, so that's the interest cost. And we have gearing ratio, which is 33.3%, which means to say if it's likened to someone who has $1 million in house and the mortgage is about 333,000 ringgit, whereas the equity of the house is $667,000. So that's what it means. But of course, they have different types of mortgages. All right, some of them are fixed interest rates, some of them are floating. All right, fixed means to say whether or not Bank Negara change its interest rates in the future, it will continue to pay that amount of interest rates. But if it's floating, like most of our mortgages, then whenever Bank Negara says something about our interest rates, like cut rates or increase rates, then our interest rates will be affected. So we look at the percentage. So I find that 94% of its interest cost is actually fixed, and the remaining 6% is not fixed. So which means to say at that time, what I know is that if Bank Negara says something about, oh, there's an interest rate cut or something like that, then whether or not there's a cut or there's an increase, it doesn't affect Sunway REIT a lot lah. All right, so that is what it means. Okay, but anyway, gearing ratio is by far the more important figure, 33%, which is below the 50% requirement rate, so that's very healthy. Now, of course, I have to look at the growth prospects. So during the time when I purchased Sunway REIT, the refurbishment of Sunway Putra Mall has been completed, and it has soft launched on 28 May 2015. That means to say they are starting to get tenants in. And when I bought it that time, when I bought the REIT that time, the occupancy rate of the shopping mall is about 84%. All right, so it's starting from way below 50%, it has actually secured more and more tenants, and it hits 84.3 million. And I even get the revenues for Sunway Putra Mall for the past 4 quarters, and as you can see, it has been on an increasing trend from less than $1 million in Q4 2015, that is June 2015, and by March 2016, it made about 11 million in rental income. So that is a huge. So I believe there is a huge. There may be a huge potential of growth lah, because it has already refurbished the shopping mall. So that's very good. But this investment, to me, it has certain form of risk lah. Like for example, number one, Sunway Tower. As I found, it has anchor tenants that left the property. So that's a huge risk to me lah. I mean, not to say huge risk, I mean to say the risk is calculated. But if you can see here, last time it was almost fully occupied. Now the occupancy rate is 18%. So I have to assess the impact of Sunway Tower to the overall portfolio of Sunway REIT at that time. So I gathered that in 2015, Sunway Tower contributed only about $12.7 million in rental income. So compare 12.7 million to how much? To a gross revenue of 453 million. That is equivalent to just 2.8% lah. So which means at that time, as an investor, what I was thinking is that I can absorb the risk lah, because it's just 2.8%. That's risk number one. Risk number two is actually Menara Sunway. It's not as bad as Sunway Tower, but it has a drop in occupancy rate as well. From above 95%, it dropped to be slightly below the 90%. But the overall impact to the property, I mean the overall impact of this particular property, Menara Sunway, to the total Sunway REIT portfolio in terms of revenue is just 3.9% lah. All right. So if you add 2.8 with 3.9, it's below 10%. So I believe that most of the properties in the portfolio is performing lah. So therefore, I'm willing to take a chance on this particular REIT lah. That was me back then in 2016. So therefore, I started to calculate my net distribution per unit. Now, that is so just now over here, this is the gross unit. You see the 6.58, 7.5. All these things are actually gross. But this is actually this is the formula that I use to calculate the net. Okay. Now, in order to calculate the net, the first thing to do is to go to the quarterly report. And the quarterly report, I have the latest 4, which is Q4 2015 all the way up to Q3 2016. So the total DPU is stated on the right hand side, which is 2.05 all the way to 2.37. All right. And the total gross DPU is 9.11. But from the gross DPU, we have the taxable portion and the non-taxable portion of the DPU. The taxable one is subjected to a 10% withholding tax. And of course, the non-taxable one is non-taxable, it's tax exempt by the Income Tax Act of 1967. Okay, so these figures are actually, there's no explanation unless you call up the investors relation of Sunway REIT itself. But these are the figures that you can copy and paste from the quarterly reports. All right, so usually it's buried under the notes of quarterly distribution lah. Okay, so usually these are stuff that I'm starting to give away to my subscribers lah. Recently, I'm starting to do all these things. Now, if you see the taxable and the non-taxable, so for the last 4 quarters, from the 9.11, it consists of 6.39, which is the taxable portion of the gross DPU, and the non-taxable is 2.72. So the 6.39 is subjected to a withholding tax of 10%, and therefore, if we deduct 10% from it, we get 5.75. So that is the net from the 6.39. Of course, the 2.72 is tax exempt, so you get the full amount of it, and therefore your net DPU, which is the net distribution per unit, is 8.47. So that's that is the amount, that's the basis of my calculation. All right, that's the net amount that I will receive.
So can you tell us what is withholding tax?
Withholding tax is a form of income tax. It's a type of income tax. And don't ask me how it came about, but it's actually stated by the income tax authorities lah. Okay, but different people have different withholding tax when it comes to REITs lah. All right, for example, let's say for me, I'm an individual investor. I'm a tax resident of Malaysia, so therefore my tax is actually 10%. All right, but if you are going through other entities like corporation, then maybe you are subjected to a higher withholding tax.
Okay, so that means if I use a company entity to buy a REIT, I may need to pay higher withholding tax.
Could be 24%. So it's best to actually, so it's good for individual retail investors lah. And don't worry about filing this into the income tax, because you will receive the net. That's the job of the REIT manager. The REIT manager will help you to pay the tax. You only collect the 8.74. You won't be collecting 9.11. The income tax authority already instructed the REIT manager to
when retail investor receive the dividend in our bank account, it was already net of the withholding tax, so you don't have to file additional tax.
Yes, exactly.
Yeah. But I know that REIT has a special corporate tax benefit. Could you tell us more about that?
Okay, so for Sunway REIT, the thing is that so we have all the way up to, let's say, income available for distribution. Okay, so this is income before the tax. Okay, so under the income tax ruling, all right, so this amount, let's start with 2015, the income is 256 million. So from this, if let's say the REIT, the trust, choose to pay out more than 90% of its this income to its unit holders, all right, then there's no tax on the REIT itself, but the tax falls on the recipient, which is the unit holders. So like for example, if you are an individual investor like me lah, then I will pay my portion of the 10%.
Yeah, so I understand. So in other words, REIT has a tax benefit. Why? Because so long that they declare more than 90% of their net income to the unit holders, they don't have to pay corporate tax. Now, if you compare corporate tax and withholding tax, which one is higher? It's definitely corporate tax, right? Yeah. The corporate tax is like 24%, for example. Okay, and personal withholding tax is only at 10%.
Yes.
So if I am the sponsor, if I'm the tycoon who owns a lot of real estate, I might as well list this real estate under the real estate investment trust, so that instead of paying a corporate tax, I will be waived of corporate tax, and I will only receive the dividend net of the withholding tax of 10%. So I can save the difference of 14%.
So yes, you can say that.
So that's a tax benefit. That's why a lot of tycoons or a lot of big businesses, they do it this way by listing their properties as part of the REITs to receive a tax benefit.
Yeah, that's very well said. Thank you so much, Jin. Yes, it's true. It's true. Yeah, that's why they come up with this vehicle called real estate investment trust. Yeah, it's a very good vehicle.
So now, investor like you and I, like Ian and me, who could not afford big properties, expensive properties, can now own a small piece of expensive properties in Pavilion, in KLCC, or even in the Sunway cluster city.
Yes, for me it's Sunway Pyramid lah. So yeah lor, if I were to continue, right, that's what I'm getting lah on a per unit basis, which is 8.47 cents lah. So that was my calculation lah, but this was back in 2016. So therefore the net yield is as followed lah.
Do you know what kind of income will separate taxable and non-taxable?
This one you have to ask the investors relation.
So you're not familiar.
I can roughly guess lah, but you see all these figures, they don't have a consistency behind it. But the taxable, okay, what I can say is that the taxable is something like this. Like if you rent your shopping mall to people, let's say retailers, and then you get rental income, this income is taxable, confirm. So usually the amount for taxable is usually a lot higher. Then the non-taxable, there are many income which is not non-taxable, but I wouldn't know the full list of it, but one of it is actually something like this. Let's say, for example, there's a sale of the property. All right, let's say, for example, Sunway REIT actually sold a property and it gets, let's say, $20 million worth of gain. So this gain, all right, I believe is classified under non-taxable. And when it's distributed to you, it's non-taxable.
So the gain from the disposal of properties.
Yep.
Yeah, but if there's any revaluation, because every year the REIT will do revaluation of the asset.
Yeah.
Investors like us don't get the benefit of the capital appreciation, right?
Yes.
We only get the rental income.
So it's like this. Let me put it down as simple as it is. So that means, let's say you buy a house, it's $1 million. Next year it's worth 1.1. So it's just paper gain, you get nothing, right? So, but it's still very important to know that, hey, my house is now 1.1. Then the following year is 1.2. Nothing happens. 1.3. Okay. Now the thing is this: at 1.3, let's say the house is sold at 1.3. Okay, so now you have $300,000 worth of gain after 3 years of holding this piece of property. Okay, so now the extra 300,000, the REIT can do a few things. Number one, they take the money and reinvest in the property. All right, so if they reinvest in the property, then you get more distribution, income distribution or dividends. That's number one. Number two, they retain it in the account. All right, they retain it in their own bank account. And then let's say, for example, the existing REITs, the existing properties, they give certain amount of income. Then they take the 300,000, they top up a little bit from the taxable portion, so that they can increase a little bit of the DPU. And they make their own REITs net distribution yield very good lah. All right. Or the third one, they can distribute one lump sum to people lah, but that's a bit rare lah. So it's usually the first two.
Okay.
So that time when I buy, excluding brokerage fees, my price is $1.65. Net DPU is 8.47 cents. So at the time, back in June 2016, I'm getting about 3.15% per annum lah, which is a little bit short.
5.13%.
Yeah, so it's not exactly my portfolio average lah. So that means I have other REITs, they are paying 7% and stuff like that lah. Okay, so this is one of my lower distribution yield kind of REITs, but I'm still willing to, at that time I was still quite early lah when it comes to REITs. So I'm happy to get 5.13%. So it's calculated as follows: 8.47 divided by 1.65, my purchase price, times 100%. So that's 5.13 lah. Okay. So I have to actually compare it with the past distribution yield. A lot of people just take this 5.13 and decide. But for me, right, I will actually compare it with the past unit prices. So if I look at the past unit prices, so this is the net DPU I get from 2012 to 2015. Okay, I compare it with the closing unit price at the time. Let's say 2012, it was priced at $1.36. 2013, 1.54. 2014, 1.44. 2015, 1.54. Actually, as you can see, I wasn't buying it at the cheapest price at the time. So I bought it at $1.65. But if you can see here, here's a key gem that I would like to impart to all of you. If you see the net DPU, over time it grows, right? Usually the new unit price will actually grow in tandem lah. All right, so that's the beauty of it. It happens in REITs, it happens in stocks. Continuous growth in profits will tend to lead in continuous growth in stock prices. So if you calculate the distribution used for each and every single year of Sunway REIT, so the average I find is about around 5 to 5.33% lah. So I find that 5.13 is still within the range lah. So it's not to say at the time when I purchased it, it was a good REIT, growth in revenue, net property income, and DPU. But in terms of valuation, it's just fair lah, all right, because it's within 5 to 5.3. But anyway, I got it lah. I grabbed it anyway. It was one of the smaller holdings in my portfolio. All right, so this is how I compare the valuation. Of course, if let's say the REIT at the time, if let's say the REIT is based on this, if I can get 5.5% for Sunway REIT, then of course it's very good lah. That means it's undervalued. If let's say the REIT is paying 4%, then it's really overpriced already lah. Then I can forget about the deal. But 5.13 at the time is okay, so I bought it. So after maths, still got time
Got, yeah, but hurry a bit.
All right. Okay, so now I fast forward to 2019. So as you can see here, the red color one is what happened after that lah. So it bought 3 properties after that. We have the Sunway Clio property, which is an extension of Sunway Pyramid. That's a hotel and some retail outlets lah, that is connecting the hotel and the pyramid. Sunway REIT Industrial One, that's a warehouse owned by Sunway in Shah Alam. And once again, just now we talked about Sunway University and College Campus. This was just acquired in December 2018.
Like, yeah, nine months ago.
But still,
yeah, 10 months ago.
But still, the retail segment accounts for 74% of the Sunway REIT lah, the entire portfolio. All right. So it's still Sunway Pyramid and Carnival that calls the shots for this particular REIT.
The Sunway Uni include the Monash?
No, I don't think so.
Okay.
It's Sunway University College.
Okay.
Now, back in 2015, when I bought this particular REIT, the portfolio valuation was $6.32 billion. It has 12 properties, but now it has 15 properties. And the portfolio valuation is $7.28 billion. That was 2019 lah. Okay. Now, if you look at the financial results, as you can see, when I bought it at the time, Sunway REIT was earning about 453 million in gross revenue. Now it has grown to 580 million in gross revenue. And when it comes to net property income, it has increased from 341 million, and right now it made about $440 million. In terms of income available for distribution, it has increased from 256 million all the way up to 283 million. So here's the whole story. All right, here's the whole story for REITs. When I buy a REIT, I know I will first check its revenue, net property income, and distribution. And I don't just look at 1 year. I look at as long as possible. Why? Because growth in all these three growth in revenue will breed future growth in revenue as well. All right, success breeds success lah. Okay, if the revenue has been growing after you buy, it has more chances, a higher tendency that the revenue will grow in the future. Of course, the same will go with net property income and as well as income available for distribution. Now, the growth is driven by the following properties: Pyramid, Carnival, Putra Mall, Sunway Clio property, the hospital, and the industrial, which is the warehouse, and as well as the Sunway University College. But still, this growth, right, as good as this growth are, there's a decline in Sunway Tower, Sunway Pyramid Tower, and as well as Sunway Hotel Resort and Spa, which is undergoing renovation. All right, that was 2009. So the good has outweighed the bad. So that's a good thing for me. So this is actually the cash returns that I received for the past 3 years. So I received my first distribution at Q4 2016, which is 1.99. And subsequently, I have received the following distribution per unit: 8.51, 8.83, and 8.92. So in that 3 years and a quarter, 3 years plus 3 months lah. So I receive about 28.25 cents, and my investment cost is 1.65. So overall, my cash return in the 3 years and a quarter is 17.13%. All right. So that's the cash. That's just cash return only. What about capital gain? So when I prepare this presentation slide, the price of Sunway REIT has increased from 1.65 to 1.93. Maybe you can Google it up and see my the what they call the latest Sunway REIT price. All right, it could be 1.91, it could be 1.95. I do not know. You can actually recalculate that. But if you take 1.93 and you compare it with 1.65, that means to say the share price has appreciated by 17.10%. So cash returns plus capital gains 17.13 plus 17.10. My total returns in that 3 years and a quarter is 34%. So you take 34%, you divide by 3 lah. Let's put it that way. My annualized returns is about 10 to 11% from Sunway REIT itself lah. Okay, and how I did it is by looking at the properties, the portfolio, the revenue, the net property income, make sure the distribution per unit is good, and as well as the I compare it with the past distribution in order to make sure that it is fairly valued. Okay, these are the key takeaway points. REITs, very good vehicle to generate passive income. But here's a big myth. A lot of people think that REITs couldn't grow in terms of capital appreciation. The good ones that keep on buying new properties all the time, especially the good ones, will provide good capital growth. Make sure the financial records are solid. That's very important. Must have a growth plan, and finally compare the current valuation against its long-term average lah. So I believe you guys have a lot of questions to ask, so I'll pass the control back to our moderator, Chun Sian.
All right, so right now it's at our question and answer session. Please, if you have any question, write them in the question box, so we'll be able to pick some of the good questions to ask. Okay. Now, along the way, we already have many questions on our screen right now. So let me ask you the question. Now, the first question is, why is Hectare REIT have the highest dividend yield, but the share price is still on a downward trend? What is causing this downward trend for this REIT?
Short answer, Subang Parade. Okay, it's a mall that is not really performing, but unfortunately, as a resident, as a person who comes from that part of the town, all right.
You come from that part of the town?
Yeah, exactly. I come from that part of the town.
You're from Klang.
No, I'm not from Klang. That's another guy. So, all right. So basically, I'm from Shah Alam, by the way. So Subang is the nearest, and Subang Parade. I grew up with Subang Parade. And it's a mall that is not actually really performing for many reasons. The occupancy rate has been declining, and that is a concern to the unit holders, because if you have declining occupancy rate, your rental income is declining, your net property income is declining, and of course, unit holders don't like that, and therefore they sell off the property. In fact, it's not really it's a good quiet place to go and visit your friends. If you want to have a good discussion with your friends, go there, because there's very few people who go and shop over there. It's not that own kind of shopping mall. All right, but that's very unfortunate. So I believe that the short answer for this question is Subang Parade.
Yeah. Okay. Now the next question is, the majority of REITs in Malaysia is on a downward trend for the past 2 years. There is actually a handful of that are increasing in value. So the funny thing is that the dividend yields are actually lower for the REITs going up in prices versus the REITs that are going downtrend in prices. Do you have any comment on that?
Okay, so it depends on what REIT. It's very hard to say. Of course, over the past 2 years, maybe some of the REITs have been a little bit more expensive. All right, meaning to say their distribution the way to calculate whether it's fair value, overvalue, or undervalue is actually look at the current and you compare it with the past. So maybe last time the valuation at that time is actually more expensive, all right, as compared to now lah, all right. So last time maybe 2-3 years back it was a bit more expensive. Maybe the yield wasn't that great, maybe around 4 to 5% or at most 6%, all right. But now I think the price maybe has fallen a little bit. Maybe some have already come back lah, but then it's very hard to say. You have to look at it at a case-by-case study lah. And it's very hard to just comment just like that lah.
Okay. It is important to note that the yield is inversely proportionate to the share price.
Correct.
The lower the share price, the higher is the dividend yield.
Yes.
It's it's the universal truth. Okay. For any securities, the lower the share price, the higher is the dividend yield.
And that is the formula to buy REITs lah.
Okay, so you want to wait for the share price to go down?
Yeah,
okay.
Of course.
So for REIT investor, which is more important? Is it dividend yield or is it the share price appreciation?
Okay, it is actually the sustainability of the dividend yield. A lot of people don't talk about sustainability. For me, sustainability is everything. So if you have a good REIT that has good properties that can sustain the distribution per unit, and the distribution per unit is not only sustainable but it's growing, that is what I look at for a REIT. But of course, try to fish for the best price lah. Don't just buy any price lah. Buy as low as possible.
So if I understand correctly, Ian, you use dividend yield to value a REIT, right?
Yeah.
Do you use other valuation metric, or it's only dividend yield?
Mostly dividend yield, but you can use price to book ratio.
So you compare the share price to the net asset value they have.
Yes, exactly.
So these are the two lah, huh?
Yep.
Okay. Now the next question is, do you still use the PE ratio, okay, to value a REIT, or ROE?
No.
So you don't look at their return on equity?
No, because the financial reports for REITs is a bit special. If you use PE ratio, because if you use earnings, right, they will include the capital appreciation. Then it will distort the PE ratio. So which means like rental income minus expenses. Then after that, capital appreciation of the property.
Yeah, because the property appreciation is also considered earning.
Yeah.
Yeah.
So you don't use that.
Okay. Yeah. Unlike listed company who always report depreciation, because of the depreciation of the property, plant and machinery, REIT will every year revalue the asset, and then when the property asset rise in value, is considered an income.
Yes.
Okay, and it is. I see.
You drive down PE ratio. Yep.
So, all right, may I know, like, our Salam REITs fall under which category?
For me, it's retail.
It's retail, huh?
Yeah.
Okay. The next question is, what are the differences between the KPJ stock and the a la carte REITs? Okay.
KPJ is a hospital operator. They operate hospital. A is the landlord. Okay. So one is a business owner, the other one is a landlord. That's the key difference.
Now, what is your opinion about the government that has an interest to introduce airport REIT?
Airport REIT. Oh, it's an interesting.
That took place like last year, right?
Yes.
When Batakam Harapan became the government.
Well, for me, I didn't really look into that, honestly. We see, it depends, all right, but it depends on when it will happen. But again, if you ask me, right, whatever REIT is it, just go through the basics, all right? I will still look at it from the angle of whether or not you want to own the property or not. So it's all back to the basics, revenue, property income, income available for distribution, and DPU.
Can a REIT pay less than 90% distribute less than 90% of their income to the unit holders?
For Malaysia, BURSA Malaysia, we have 17 REITs. None of them pay below 90% because of tax reasons. So I would say it's not a likely case lah.
Yeah, because if they distribute less than 90% of their income to the unit holders, they are defeating the purpose of listing it as a REIT.
Correct.
Okay. Now, the next question I have on my screen is how does the Sunway REIT manage to get such a low average cost of debt, about 3.8% if I'm not mistaken?
That one I didn't really consider back at June 2016, but I suppose they have good relationship with bankers lah. You know, they are property developers. Who knows? They have good banker friends. Maybe they get good deals from there lah.
Okay. So the next question is, how do we buy REITs?
Oh, good question. We have a dozen of brokerage firms. All right, you can, if you are using any bank, you can check which bank is actually having which bank has a stock brokerage firm. Then you can go with them, or alternatively, you can look at other pure play stock brokerage firms like Rakuten, M&A, or M Plus. You can actually find them in all sorts of places. Just Google up and find the best one for yourself.
All right. So where can we find the information on forward dividend yield?
For me, I don't use forward dividend yield. All right, because forward means you are trying to predict something in the future, but I don't think that's a good thing lah. All right, for me, you use what is available at that moment lah. As you can see, the case study was presented based on the information available. You can get all this information from Bursa Malaysia for free, and that's how so just now the whole case study, if you know, that's how I actually use the information lah, to actually get the 10 to 11% per annum from Sunway REITs. But for forward dividend yield, I don't use.
You don't use you only use the past.
Yes, past and current.
Okay, now the next question is, Capital Land in Singapore and Malaysia the same company?
Now, Capital Land Malaysia Mall Trust is a REIT that is listed in Malaysia. The sponsor is obviously Capital Land, and Capital Land has a few REITs in their name lah. All right, the Malaysia one is the Malaysia Trust, and then we have the Capital Mall Trust in Singapore, and as well as Capital Commercial Trust, and as well as Escort. That one, Escort Residence Trust. That one, these three REITs are in Singapore. All right. Of course, if you want to look at them, no harm also, you can look into them. But Capital Land itself is also a listed company. It's a property developer. All right. So what they have in Malaysia is Capital Malaysia Mall Trust and some holdings in MQ REIT, MRCB Quill Trust, or Q REIT. So that, there's a story behind it. Last time it was called Quill Capital Trust, because Quill is the largest shareholder, and then Capital Land was the second. Then when MRCB came in, there's a name change because Capital Land became the third largest shareholder or unit holder, and then Quill become like the second, and MRCB become like the first lah. So that's why there's a name change lah. So if you ask me whether or not they are the same company, they are not lah. Malaysia one runs independently from the Singapore ones.
Okay.
Hence the quality is a bit the same. It's also not the same lah.
Management different, okay? Owner different. Now, so
owner same, management different.
Management different. Okay. Now, is it sustainable to only invest in REITs?
It depends on what you want to achieve in your own portfolio lah. Like for example, if you want to invest in purely for dividends, it can work, all right, and it can also be sustainable. It depends on how you actually construct the portfolio lah. So at the end of the day, it depends on how you want to design your own portfolio. That's very important. But this one, it depends on case by case lah. But if you ask me whether you want to build a 100% full-fledged REIT portfolio, that is stable, that pays out increasing dividends, and as well as achieve some form of capital appreciation, still can. You can do that.
Okay. So the next question is there a platform where we can find all the REITs information?
The best, you mentioned the best place, right? BURSA Malaysia lah, but BURSA Malaysia is the best lah. Because number one, if you want to have a full-fledged platform to assess REITs in full, right, you still have to go back to its annual reports and quarterly reports lah. That's the best place. Like the net DPU thing, there's no platform that gives you the net DPU figures. You have to get it from BURSA Malaysia itself, download the quarterly reports, and dig it from the notes of the financial statements.
Okay.
No other way already. Sorry about that.
Now, in between the dividend yield versus the price to book value, which is your favorite valuation ratio?
Given the two, I still prefer DPU lah.
DPU lah. Now, how do we look for the occupancy rate kind of information? Is it available on public web?
You go to, there are two places lah. One, if you are looking at Sunway REIT, of course you can go to Sunway REIT's official website to get it, or alternatively, it is the information is found in BURSA Malaysia itself. And all these are free, by the way, so you don't need to pay for anything. You just need to. The only prerequisite to be good in this business, right, the business of investing in REITs, is to be diligent in reading reports.
Like investing in listed companies as well.
Yeah. You just need to rajin membaca lah. Let's put it that way.
So does REIT issue warrant or rights issue?
Rights issue, yes. Warrant I haven't seen, not yet lah. Maybe got, but then I'm not aware of that lah. But that's not the biggest issue. But rights issue can be a good or bad thing. Alright, it depends on why they come out with their rights issue. Sometimes they come out with rights issue because they need to raise money to buy property and they don't want to be overly geared. So in that case, then rights issue is a good idea lah. All right, good idea to actually buy the property for many reasons. All right, number one, if the REIT has new properties, and let's say it's a good one, then it will diversify the income into another property lah, which makes the portfolio of the REIT stronger in terms of their income generation. And of course, sometimes this kind of acquisitions will help to increase the dividend yield, because higher dividend income, higher dividend yield lah. So in some of these cases, the rights issue for REITs can be a good thing, both to the REIT and to the unit holders.
Okay, now the next question is, for dividend received from REITs, do we need to file and declare personal income tax?
No.
No need?
No need.
Okay, so the next question is,
but of course you can clarify with the tax agent lah, because I'm not a tax agent, but I got the tax voucher lah, so it states there the tax has been paid already lah.
Yeah, because there's a withholding tax. Okay, so next question is, for dividend yield investor, how many percent of REIT should we have in our portfolio? Would you recommend?
How many
percent should we allocate for dividend investor? How many percent should we allocate into having REIT in our portfolio?
I don't have a specific figure, but for me, whatever I buy, right, it's all dependent on the REIT's sustainability lah. Okay. Which means to say, I look at the portfolio itself. If it's stable, I will actually include in. All right. So I don't have a specific figure. For it, but I make sure that every buy, let's say I have 10 stocks in my portfolio, right? I'll make sure that all 10 are pretty good stocks, and their weightage are actually, how do I play this? Okay, because some REITs they have a lot of properties. Like Sunway REIT is far more diversified. Some REITs they may not be so diversified. all right, they have lesser properties. So in that case, if you want to build a stable portfolio, you can allocate more money to REITs that have more properties, and then you buy a little bit lesser when it comes to REITs with fewer properties lah. But again, to your question, if you say the full amount of stocks, is it wrong to actually have 100% full REITs? Also no. If you say 50-50, also no. It's not wrong, and it's also not right either lah. So it depends on personal preference lah. Whether it's 30-70, 60-40, there's no right or wrong answer to this.
Okay. Now, since a good REIT is a consistent growing asset and is giving out dividends consistently, should I be investing in the REIT without looking at the current share price?
Since what? Good REIT?
Since a good REIT is a consistent growing asset and giving out dividend consistently, should I be investing without looking at the current price?
Oh, wrong. You have to look at the chart. You have to first look at the DPU and all this stuff first. The last thing you look at is stock price. But having said that, you have to look at stock price. It's the last thing. It's not, don't look. You look at the last thing. That means you can look at many things, but make sure the last thing you look at is stock price. And usually for investors, the whole mantra is always the same. The whole model is the same. The modus operandi. You always buy the good things and you try to get it as low as possible. So if you buy Sunway REIT, let's say at $2.50, then I won't buy already. I'll probably sell.
Now we often talk about just like talk about the five area where we can assess how to evaluate the REIT, right?
Yeah.
The consideration we want to buy REIT. Can you tell us like when should we sell a REIT?
Oh, let's say for example, if my Sunway REIT, if you look at if let's say the yield is actually around 4+%, all right, it's not exactly underpriced, then if you want to cash out, then you cash out lah. All right, the lower the current distribution yield, the more incentive for you to sell lah. All right, so let's say for example, okay, let me give you an example. Let's say a REIT, all right, you look at the past record, the distribution yield averages between 4 to 6%, where the 5 is the middle point. All right, so 4 is overpriced, 5 is fair, 6 is undervalued. So if the REIT is giving out 6.1%, you buy because it's underpriced or undervalued. If the REIT is paying only 3%, then sell lah, because it is even more overpriced than when it was offering at 4%. So why would you want to buy a REIT? Why you want to buy more? Why you want to hold a REIT if it's paying at 3%? So you might as well cash out at that time lah. So that's what I think.
Okay, so the next question is, what do you think about IGB REIT, which only has 2 properties but does not seem to have much growth after this? Why does share price keep increasing?
IGB REIT did well for many reasons. Number one, although they have 2 properties, but the 2 properties are performing lah. That means to say they have grown in terms of gross revenue and net property income. And because of that, and somehow rather, I believe that although they didn't actually invest in new properties, but I suppose they have increased in terms of their existing rent lah. That means they rent to their existing tenant at a certain rate. After a few years, the tenants decided they still want to be there, but then they have to pay a higher rate lah, at a little bit higher price. So because of that, the property valuation will also go up, income go up, capital appreciation go up. So of course the stock price will also go up lah. But of course there are many other reasons, all right. There are many other reasons why IGB has actually gone up in price. Because number one, maybe it's because the income is far more stable. If you check if you compare with the 17 REITs. Of course, IGB REIT is one of the better performing one lah. Better performing one in terms of delivery of their financial results. So maybe that attracts a lot of investors. So it all falls back to the same principle. Higher income, higher sales equals higher income leads to higher capital appreciation lah. So even the boring type of REITs like IGB REIT also can perform, but so it makes investing, right? You don't need to speculate, you don't need to do forward projections, or you don't need to speculate what will happen in the market. You just need to follow the financial performance and try to fish for this kind of stocks when the price is low lah, and you still can get your returns up.
Okay, now in short, REIT is a good asset that you should consider if you target the dividend yield and the steady growth in terms of share price. So if you are risk averse kind of investor, REIT is something that you should consider to have a bigger portion inside your portfolio. And you're a passive investor, your ultimate goal is to get more income, passive income through dividends. REIT is a great place for you to go into because they don't have to pay corporate tax, because they declared more than 90% of their earnings, the net income to you as the dividend. Then so long that they do that, they are waived of the corporate tax.
Yes.
And then you can own prime land properties, so without putting in a lot of money, by just buying amounts that you can afford to invest in. And you don't have to manage the property yourself, because there's a professional property managers that manage the properties for you. So these are
I mean to say it's good. Like okay lah, let's do a shower for BURSA Malaysia lah. All right, so for REITs, right, the entry point is very low, because most of the REITs are actually priced at $1, $2 and stuff like that. So you can actually enter, let's say 1,000 or 2,000 ringgit, you can buy yourself a REIT already. So actually everyone can participate in this game lah.
With that, thank you so much for being a wonderful audience, and I want to thank Ian for spending your evening with us to share with us what is REIT and the introduction of REIT.